In my 5 years of being a liquidity provider, specifically in concentrated liquidity pools, as well as working with a family office back in my day and doing risk assessment on liquidity pools to see what puts the most money in your pocket at the end of the day, I've analyzed over 10,000 liquidity pools. That's a lot. And I want to show you where the real yield actually is, what's profitable and what's not. But more importantly, I'm going to give you the playbook so you can do this on your own and you don't have to always rely on me in the future. Now, with that being said, this right here is my software company, Metrix Finance. We have some great additions coming, including a whole new revamp with Metrix V4. But for now, we're going to be using the Discover, Simulate, and Track functions. So first things first, we need to look at Discover and we need to find a pool. Let's just say we were to invest into something like Ethereum to wrap Bitcoin. What a lot of people often overlook is the fact that you're optimizing for what puts the most money in your pocket. You are not optimizing for the highest APR. That right there is a fundamental shift that you need to drill in your head. A lot of people like to look for the highest APRs because they think, oh, that's going to generate the most income. Most income, I can compound that, make the most money. Boom. But that's not the case because there is something called impermanent loss. You see, when you invest into a liquidity pool, you have a pro and you have a con. Your pro is that you now generate income. Your con is impermanent loss. So those two things are meant to offset each other. We're looking for more pro than con. Pretty simple math equation. Now, looking at something like Ethereum wrap Bitcoin, basically, we dive in here. Let's just say we select our range, yada, yada, yada. We run our simulation and it's like, oh, we're doing 53% per year. Just because it says we're doing 53% per year does not mean that we should dive into it. You see, what we need to do is we need to back test this. We need to see how much impermanent loss that we can have. So how I typically do that is by heading over to CoinGecko or any other trading view software. I'll take a look at Bitcoin and I will take a look at Ethereum. So looking at the price of Bitcoin over the past month, I want to look for periods of volatility, both on the downside as well as on the upside. Take a look at this. Going from February 25th at $69,000 all the way down to February 28th at $63,000. That's over the course of 3 days. So over the course of 3 days, we could see an 8.7% decline in the Bitcoin price. Well, let's factor that in. By going over here to simulate position performance, we take a look at the Bitcoin price right over here. We grab the current price and we subtract 8.7% from it. That puts us at 65,902. We throw that right over here. And then we do the same exact thing for Ethereum over the same exact time frame. What we're doing is we're back testing our divergence or impermanent loss, basically. So looking over here, February 25th, $2,100, we can say, all the way down to 1841. So let's just say 2100 to 1840. That right there is down 12.4%. So now we grab the current price of Ethereum, which is 2121, and we subtract 12.4% basically. That puts us at 1858 per Ethereum, which is down 12.4%. So now that we've done that, we have back tested how much impermanent loss we can have. You'll see that we have $9.66 of impermanent loss, which is 1% of our position value or our initial deposit of $1,000. Now, what I really want to pay attention to is how many days of yield does it take to cover this impermanent loss? Because that took 3 days to have that impermanent loss. If it's going to take us a week, if it's going to take us 2 weeks to cover that impermanent loss, why dive into the pool? Because we're talking about outweighing 3 days of divergence with a week, 2 weeks of yield. Does that make sense? No, absolutely not. So when we scroll down right over here, it'll actually show us how many days it takes to cover that. In this case, 6.7. Now, I don't think that's horrible, but I also don't think it's good. I may or may not still dive into this position. Now, the reason why I don't think it's horrible is because we can retrace the divergence loss. Meaning, for example, if we diverge, like we did right over here, we were trending sideways and then we diverged, price went down, but price eventually returned to where we're currently at, basically. Meaning that any impermanent loss that was accumulated on the way down went away on the way back up, basically, to the current price. That is assuming that you made no adjustments to your actual position. So that's why I'm thinking, well, 6.7 days, if we can retrace some of that, it's not so bad. And we're also not going to see divergence loss every 3 days. So what I just showed you is how you can check those things ahead of time before investing into pools, as opposed to being surprised with divergence loss after you invest into those pools, basically, right? You want to make sure that you do that on the downside volatility as well as the upside volatility, and always use the exact same time period. So you're looking at actual real results based on past data. Now, again, past data does not predict the future, but it does give us an idea of how things actually can perform based on history, because you've probably heard the saying, history repeats itself. Now, taking a look over at the track section of Metrix Finance, I want to show you a pool that I'm currently invested into, which is Ethereum to Tau. Ethereum to Tau, I have a $1,300 loss over here, but I have a $270 profit compared to the market. So let's dive into that. Again, the goal is not to optimize for the highest APR. The goal is to optimize for money in your pocket. So that's where we created something called retention, earnings retention, basically. It tells you how many of your earnings you are retaining after impermanent loss. And it's a very simple math equation. I'll show you. So for example, I invested $10,079 into this liquidity pool. That liquidity fell to $8,335, meaning that liquidity went down $1,744 right there. Now I've generated $421 of earnings, which means that my profit loss is negative $1,322. Now, just because I generated $421 of earnings does not mean that I am outperforming the market. I could very much be underperforming the market. What does tell me that I'm outperforming the market is a positive retention, which you'll only see on Metrix Finance, as well as a positive versus HODL number. And by the way, if you want to see these numbers on your own portfolio, you can head to the link in the description, sign up for Metrix Finance. We have number one, a free version, and number two, if you sign up for a paid plan, you don't like it, within your first 7 days, we will give you a full refund, no questions asked. Just simply go to the bottom right-hand corner, open up a little support ticket, and we'll respond to get you refunded. But looking over here at this divergence loss section on Metrix Finance, I want to show you how this math kind of works, basically. It tells you how much you would have if you held in the market in your initial asset split. Our initial asset split in this pool was 80-20, 80% Tau, 20% Ethereum. So if we just held those assets, we didn't do anything with them, we didn't pool them or anything like that, we would have $8,490. Well, since we're in the pool, we have $8,335, meaning that we have $154 of divergence loss. We calculate that by subtracting this initial asset HODL number from our current liquidity. This number right here is always going to be negative. This one in specific. These other ones can be positive, but this one in specific will always be negative. Now, with that being said, though, we simply just add the earnings to this number, because this right here is our con that I was talking about, and this right here is our pro that I was referring to. So we add the pro to the con, and that gives us the net, or the versus HODL number, basically, which, as long as this is in the positive, you are outperforming if you just held your initial assets. So that's $267. And then once again, only seen on Metrix Finance. Very simple math calculation, and our competitors will copy us now that I'm exposing this advanced math. You divide $267, the versus HODL, by the total earnings of $421. And that tells you how many of your earnings you are retaining. In this case, 63%. Cool thing about Metrix is we also show you a couple different options as well. What if instead of 80-20, you held in 50-50? What if you held all your money in ETH? What if you held all your money in Tau? In this example, my pool is outperforming every single metric, which means I am definitely outperforming the market, which is my benchmark. That's what I want. Because in a bear market like we're currently in, my goal is not to profit. I know I'm going to see capital loss. I know that's happening, but I believe in these assets for the long term. I'm holding them out for the long term. My horizon is much longer than most crypto investors, or I should honestly say traders. My horizon is multiple years, like 5 to 10, right? So I'm not focused on trying to sell the high, buy the bottom, making a bunch of emotional trades, and eventually quitting crypto because it's a scam and doesn't work out. I'm focused on acquiring more assets while the market moves down, and that's exactly what I'm doing. So as long as I'm positive down here on this row, that means that I am acquiring more assets, basically. So that right there is my words of wisdom when it comes to actually analyzing where the yield actually is and what puts the most money in your pocket. Remember, this right here is a vanity metric, because you could have a 1000% APR, but all of these numbers could be red, or these numbers can be green, but you're in a meme coin that you don't want to hold, and you're down regardless, and you have to sell out of it. But when you have assets that you believe in your portfolio, you truly believe in them, you have a long-term investment horizon with them, you're willing to kind of just like forgo the fact that you're going to lose a little bit of money along the way, then you can use this to acquire more of those assets, right? And then compound those assets strategically. I don't just mean earnings reinvest. I simply mean taking these earnings and allocating and distributing across your portfolio. If you guys want me to make a dedicated video on that, drop a like, subscribe, notifications turned on, and of course, If you want to see your portfolio, just like I showed you today, and simulate before you invest, you can head over to Metrix.finance in the link at the top of the description. Remember, if you don't like it within 7 days, we will give you a full refund, no questions asked. I'll see you guys in the next video. Peace out.